It is time for a complete reset of the way we approach our businesses, and we even approach asset management and investing. The idea that we can continue doing what we have been doing when the world around us is fundamentally changing seems to me not a very good idea.
Welcome to Leaders Unplugged. Leaders Unplugged is a real talk with the impactful. Presented to you by IMD and hosted by IMD's president, David Bach, and myself, Felix Seltner, founder of Remote Daily. Our guest today is Maria Vassalou, head of the Pictet Research Institute and one of the sharpest minds at the intersection of finance, geopolitics, and innovation. Maria is one of those rare leaders that had a successful career in academia, went over to the business side, and built a successful career in the financial industry. In a conversation with David, she argues that as global trade rules unravel, AI accelerates, and demographics shift dramatically, leaders need to rethink everything. So listen in and challenge your assumptions, from US tariffs to BRICS, from China to Europe. Recorded at IMD in Lausanne, here's David Bach with Maria Vassalou.
So Maria, yesterday I had the opportunity to be with the executive team of a large global multinational. And essentially the question we discussed together was, what the heck is going on? Every day there's news about tariffs and trade war and new geopolitical tensions. Is there some method to the madness? I'm sure you get the question a lot from your clients, from your partners. What is going on? Can we make sense, big picture, of what's actually transpiring?
Yes, this is a question I get a lot, because just like the people you were talking to yesterday, a lot of people are asking the same question. And the way I understand it is the following. Let's think about how the global financial system has been working for the past many years. And what we are seeing is that since the end of the Cold War, we have been having in place an global financial arrangement by which the rest of the world will ship their surpluses to the U.S., and in return, the U.S. will send to the rest of the world, will provide rather to the rest of the world, U.S. dollars that have been used as a reference currency for global transactions, U.S. treasuries that are used as safe assets for collateral and repo purposes, etc., and U.S. equities. And this has been going on for a long time, and the rest of the world got heavily invested in the U.S. in the process, owning about 40% of U.S. equities and almost the equivalent of U.S. treasuries and safe assets. And so this has been going on for a long time, and it worked to the favor of everybody involved. But this is to the advantage of the U.S. to maintain this global financial arrangement to the extent that it can continue providing this attractive equity returns. And let's zoom into this for a moment. What gave rise to this great equity returns from the U.S. perspective that also gave rise to the discussions about U.S. exceptionalism and so on? Well, the U.S. didn't just take the surpluses of the rest of the world. It actually used it to invest in technology and innovation. And that's, to a large extent, what has fueled this great performance in U.S. equity markets. And the U.S. has been a leader in technology for a long time, by far, compared to everybody else. But what has changed in recent years is that the leadership of the U.S. in technology is being challenged. And it's being challenged by China. And so, to the extent that the U.S. risks losing its leadership in technology, it no longer makes sense for it to promote free trade and globalization and world peace, because under those premises, it actually erodes even faster its advantage in technology, its ability to remain a world leader. And that's why now we see the US trying to change the terms of trade.
So this is then less a story of President Trump not believing in free trade or not believing in alliances, but what you're saying is this is a long-term structural shift, and any responsible U.S. administration would try to reset the terms of the global economy. Is that right?
Yes, and actually, this is not a new story. Already, George W. Bush was trying to address the imbalances between the U.S. and the rest of the world. Obama tried to do it. Trump tried to do it, and he came into agreement with China, under which China would have to buy $200 billion more of U.S. goods per year. China signed that, never really implemented this agreement. Then the Biden administration also tried. And in fact, the Biden administration not just maintained the tariffs of the first administration of President Trump, but it expanded them in terms of breadth and increased the rates. And that was also not sufficient. And so finally, Trump comes to power again, and in his usual style, it does something dramatic to capture attention and to get the people, the other countries at the negotiating table. And that's really what we're experiencing. He had to use a shock and awe approach because otherwise things were not working.
I can imagine a lot of business leaders listening to this and actually being quite sympathetic, right, to the U.S. deciding after decades of providing global leadership and global stability, look, we're not benefiting from this as much anymore. Providing public goods is expensive. We need to reset. And in fact, to some extent, as you said, this didn't start with Trump's second term. It started before. And certainly in the first Trump administration, the writing was on the wall with the trade war with China. And in that context, it seemed that the U.S. was encouraging American companies, European companies to shift from a dependence on China to leverage other markets in Asia, to leverage, for example, Mexico as a lower cost location from which to supply the U.S. market, right? That's why you get this big boom in Mexico, particularly the northern part. I was in Monterrey a few weeks ago, and I could very much see how dependent that part of Mexico has really become on the U.S. And so business leaders sort of responded to some extent, right? Investments that were consistent with the idea of the U.S. reducing its dependence on China. And now they don't know what to do anymore, right? So now there are tariffs on Mexico, now there are tariffs on Thailand, on Vietnam, on other places that people went to when they tried to reduce their dependence on China. There's a possibility of high tariffs when it comes to India, where a company like Apple, for example, has shifted some of its assembly or has plans to do some of its assembly. What's your advice to business leaders who are saying, look, I get the idea that the U.S. wants to change the terms, but give us something stable that we can work with as opposed to this, changing every day, promoting perhaps one location and then slapping tariffs on it the next day. This has got to be a very, very difficult environment in which to make investment decisions.
I would agree that the way these tariffs were implemented were not left a lot to be desired. So I think President Trump wanted to use a shock and awe approach and really capture the attention of the world. And so they came out with this exorbitant tariffs against everybody in the world. And the purpose was basically to get the reaction of the various nations and make them come forward to negotiate with the U.S. And this is underway to a large extent with a number of partners. But it is also the case that some of these tariffs don't make sense at all, and they inadvertently hurt some corporations and some businesses in a way that could be detrimental for them. So I think there are two things that need to be done. A, some of these issues can be ironed out through the bilateral negotiations with the government. And B, business leaders need to inform the administration about the consequences of these tariffs in a way that also takes into account what the administration is trying to accomplish. So there may be cases where it's not to the U.S. advantage to impose those tariffs. And there may be other cases where these businesses will need to change tactics or change, strategy to be able to adapt. But I think these business leaders need to be in discussion with the administration to provide this intelligence, if you like.
We've spoken a fair amount about China and the challenge that China's rise in terms of economic power, military power, technological capabilities poses to the U.S. But you argue that this isn't just about China, that China is very effectively leveraging the BRICS community, if you will, or alliance to really upend decades of prior patterns in global governance. You've written a paper recently about the role of the BRICS in the evolving landscape of global governance. Help us think about BRICS. I think there's some people who believe that BRICS is sort of an outdated concept, and others who think that understanding BRICS is essential to figuring out what the next couple of decades could look like. You seem to be in that latter camp.
Yes. What is impressive about China is how strategic it is and long-term in its thinking. And China was traditionally a country with very few resources, very low income, and it managed to get to the point where it controls deposits of commodities and resources across the spectrum, from rare earths and minerals to industrial metals to food to energy to precious metals. And it didn't do that alone, and it didn't do it overnight. It started with a Belt and Road initiative, but effectively that created some bad taste in some countries' mouth, and it really provided a backlash against China because of debt issues that were created in the process. And so BRICS is another way for China to hide behind this coalition of countries, but also strengthen its capabilities across a number of dimensions that are important for future growth. So if you look at all these countries, each one of them individually may not look particularly important and may not really have a lot of punch on their own, but altogether they provide quite formidable advantages. And the selection of the countries that enter the coalition is done on the basis of how they contribute in terms of one of those dimensions. And the dimensions are technology, energy resources, commodities, trade routes, military capabilities, demographics that will support good consumption and bigger markets going forward. So it's not a haphazard coalition of countries. It's a coalition of countries that provide some advantages to China. Take, for example, Indonesia. That was the latest country to be admitted to the coalition. Indonesia controls the Straits of Malacca, which are the most important straits from a trade perspective, both for energy and for containers. So being able to have a country that really controls that passage is very important for the movement of Chinese products.
So I want us to double click on this because it's an argument that I have not encountered like this, and I'm quite intrigued by it. You argue that for the longest time, certainly also from an investment point of view, we've been thinking about developed countries and developing countries, or we've been thinking about, advanced economies and emerging economies. And you're arguing that it's less about traditional definitions of wealth, GDP per capita or anything like that, that we should look at to think about categorizing countries, but rather it is about what matters in this next round of global competition, if I understand it correctly. And I just want to repeat it. You talked about technology, energy supply, critical commodities and resources, right? Trade routes. So expand on that a little bit. What led you to conclude that competition really is about that?
Yes, so we are going through a period of another general purpose technology revolution. So we've gone through the robotics, and they're going to be maturing in terms of their diffusion process in the next few years. And then we have AI coming along, which is still at the bottom of its J curve of development and diffusion. And these things happen also at a time where the world is facing a demographic crisis. The developed world has deteriorating demographics, and we're going to see a significant decrease in population in the next 20 to 30 years. And so being able to promote growth in that context requires smart use of technology and really a strategic process of investing, both from a government perspective, but also from a company, enterprises perspective, to be able to meet the demands of the future and the changing consumption patterns, because as populations age, their consumption patterns also change. So to be successful in the next 20, 30 years, you need to be able to invest in technology in the right way. And to do that, first of all, you need access to the technology, and you need to be able to, if not being a leader, to at least be a competent follower. But you also need resources for that, because this type of GPTs are very resource intensive, both from an energy perspective and a commodity perspective. And of course, in the context of shrinking population, production efficiencies are very important. And so the traditional definition of developed markets and emerging markets is really challenged, because what constituted a developed economy before is not going to be the same as what is going to drive those economies in the future. And I would go as far as arguing that this distinction between developed and emerging markets is no longer relevant.
So what does it take then for business leaders, perhaps Western business leaders, let's start there, to thrive in this environment, right? I continue to encounter this when they think about some of the economies you mentioned. They think about the population size, they think about the consumer market, but I'm not sure people have figured out that what they need to be looking at is, what are the technological capabilities? Do you have abundant energy to power data centers? Is this place located in a sort of geostrategically pivotal place because of trade routes, right? What is the sort of toolkit that leaders need to be successful in a world that, as you're describing it, sounds and feels quite different from what most executives have grown up with over the last 20, 25 years?
It is very different, and it is time for a complete reset of the way we approach our businesses, and we even approach asset management and investing. So a lot of what we are doing and a lot of the practices, both at the business level and investing level, have been developed under the principles of globalization, free trade, and world peace. And all these three principles are being challenged. And so the idea that we can continue doing what we have been doing all these years when the world around us is fundamentally changing seems to me not a very good idea.
So your next paper looks at demographics and technology and the interaction. And of course, the way a lot of people think about this right now is, AI is going to destroy jobs. Technology is a big threat to employment. How do you think about the way technology and demographics, people, the size of the workforce are actually going to interact in the years to come?
Yes, there is a lot of focus on AI potentially destroying jobs. But when they have this discussion, they somehow forget that we are also going through a period of deteriorating demographics that will become even worse in the next 20 to 30 years. So, in fact, this technology is coming at the right time. And that can actually help very much both with maintaining productivity, maintaining GDP growth, and really help alleviate some of the pressures that societies will face as the population ages. What is also interesting is to zoom into the interaction of demographics and technology, because it's not just that the number of people living on Earth will go down, but the composition of the population will also change. And that also affects their consumption patterns and consumption preferences and needs. And so some of these technologies can actually very much address those needs in terms of, think of smart home solutions or automations that can improve diagnostics in healthcare or other things. And so I think there should be a lot of excitement about how these technologies can address a lot of the issues that we will be facing from a demographic perspective. And the countries and companies that will be winners going forward will be the countries and companies that really make strategic investment decisions along the dimensions of demographics, technology diffusion, and production efficiencies.
I think this is such a good point. And one of the things that has frustrated me very much about the political and policy discourse about China is that policymakers, I'm generalizing here a little bit, to some extent also business leaders, but more so policy leaders or policymakers, are still stuck with the idea that China is a low-cost manufacturing hub driven by abundant labor. And of course, we know that there is labor scarcity in some parts. We know the demographics. But of course, what has happened is just massive automation. And so you have the second most populous country in the world that also leads on robotics and automation, where in some of the newly built factories for EVs or other technologies, the people who work there are maintaining robots. They're not actually doing the physical assembly.
Absolutely. I was actually in China in December, and I visited a lot of the high-tech companies there. For example, if you go to the factory floor of BYD, there is only one worker who in a costume that just checks whether the robots work properly. But otherwise, you don't see people around. I mean, they are completely automated. And I think anybody who still views China as a low-cost country that we should not worry about, and not worry in the sense of
technology leadership. Right?
Yeah, exactly. I think they need to go and spend some time there, because they're very, very impressive in terms of what they have accomplished and their capabilities. And also the huge advantage that China has relative to the West, given where we are in our history and the challenges that we're facing, is that China is in a position to do long-term planning, and they have been doing this from at least the 1970s. And so this is paying off, whereas we need to move to a point where we have strategic national planning for a lot of these things, for strategic industrial planning, national security planning that transcends the governments that are in power at each point in time. And we're not doing that.
So I'm sure folks listening might say, man, this is really bad news for Europe in particular. So I'm not going to ask you if it's bad news for Europe in particular. I'm going to ask you to do the opposite. So Blackstone recently announced $500 billion investment in Europe. What is the case for investing in Europe? in the world that you have described, where the US is trying to reset the terms of global trade, China has put together a coalition of countries that are challenging Western leadership by leveraging the technological capabilities, their energy resources, their geostrategic location, right? So is there a case, as Blackstone seems to see it, for doubling down on the future of Europe?
It's a wake-up call for Europe, what is happening around it. It's an absolute wake-up call, and hopefully they will respond to it. I mean, Europe has been very complacent in terms of not investing in its future and its infrastructure, not taking full advantage of its educational system, which is of very high quality, and of the people that it produces. So it traditionally exports these people to the US and other parts of the world. So I think Europe can catch up to some extent, but it needs to make some brave decisions. And, Blackstone is a smart firm, so I'm sure they have looked into it carefully. And I can think of many ways in which one can invest $500 billion in Europe, but that will not solve the problem of Europe. But certainly there will be opportunities to invest. But at the end of the day, they need to make decisions about their energy usage. Europe is not energy independent. It can no longer depend on Russia or the US for their energy. Clean energy is very nice and noble, but it cannot fulfill all the needs of Europe. Europe needs to turn nuclear, and it really needs to have a portfolio of energy resources it uses, because they cannot really advance in terms of the new technologies if they don't have energy. And then they need to create the necessary infrastructure to be able to both use and diffuse those technologies.
I'd love to conclude by just asking you a little bit about your own trajectory. I mean, you've had an incredibly impressive career, working at many leading financial institutions and advisory institutions. But you started out in academia. You were sort of on this side, if you will. And there are folks who start out in business and then pivot to as academia, but there are fewer who have prolific academic careers and then make the switch over into the private sector, particularly into the world of financial services and asset management and advisory. Talk just a little bit about, what that was like for you to, move from academia to the private sector, and what it's been like. What do you like about doing research on questions that a lot of academics think about, but, from outside of traditional academia?
Well, academia always attracted me because I like to think deeply about the issues and trying to get to the bottom of them, and not just have a superficial understanding of various things. So that was the reason why I decided to do a PhD and go into academia. And my field was asset pricing, and really where I ended up working was in the interrelation of macro and finance, and how macro factors affect asset returns. But I was always doing this within the rational expectations framework. And I always thought, well, if you see an asset pricing anomaly that persists, most likely it's not an anomaly, it's a source of risk you haven't taken into account. And so I would try to understand what could be behind that. But when I was in academia, it was also the time when behavioral finance became very, fashionable, I would say. And what we would do would be to go to conferences and argue about whether something is due to a behavioral explanation or a risk-based explanation. And after a while, it became obvious to me that there was no way we could settle this debate from an academic perspective, because you couldn't even distinguish at an empirical level what was what beyond reasonable doubt. And so given how my research evolved, it it seemed to me obvious to move to the industry, start getting involved in investing. I created a global macro strategy, hedge fund strategy that was investing across global equities, fixed income, currencies, commodities, and credit, and try to run it and see how it goes. Well, I survived doing this for 15 years. I learned a lot in the process. And yes, markets are quite efficient and quite rational, but not on a minute-by-minute basis or on a day-by-day basis. And it was also a great time to be in the markets, not from the perspective that returns were abundant and it was easy to make money. I actually moved to the industry at a time that was much harder to make money because I started investing in 2007, so just before the
impeccable time.
Yeah, exactly.
Right?
I spent the best years in the markets writing papers, and I moved at the worst time to the industry. But it was very instructive because I got to see a lot of important developments in the global financial markets from up close. And so I feel fortunate that I had the opportunity to first spend time on research and get good foundations in understanding financial markets, and then move to the industry. Because once you have the stress of the markets on a daily basis and, the stress of the P&L, you have less time to dig deeper. But now I find that what I'm doing is particularly exciting because I get to combine the two and use both my industry experience and my research capabilities to really try to understand where we're going and how this may affect our business going forward.
Well, look, there's a lot of critique, and I think appropriate critique often that academia is too far removed from practice. And then, of course, we have people who are, in the market with their head down, and it might be difficult for them to really scrutinize what is going on. And so it's rare to have somebody who has credibility in both worlds. That's exactly the kind of bridging of academia and practice that we hope to do here, that we strive to do here at IMD. So I'm so grateful that you took the time to have this conversation with us. I learned a lot. I'm sure folks listening are learning a lot as well. We should check in with one another because, there's a lot that you put on the table about the future. And, it's going to be interesting no matter what. So thank you for bringing some clarity and some rigor to some really, really big, important, meaty questions.
Thank you for having me. Thank you, David. It's been an absolute pleasure to be here and talking to you.
Thank you.
Thanks.
Thank you for listening. Leaders Unplugged is a co-production of IMD and Remote Daily. This episode was produced by David Bach, Caroline Copley, Frank Taburing, Delia Fisher, and Rabea Debus. If this episode sparked new thinking for you, please share it and subscribe to Leaders Unplugged on your favorite podcast platform.